And if anybody real quick could just confirm that they see my screen all right, I'll put it into
yeah.
once I get that confirmation.
Visible.
Yep, I see it.
We see it.
Awesome. Appreciate it, guys. Okay. So tonight's presentation is going to be on the topic of paying off your mortgage versus investing. So this was if you're on Twitter, following any of the admins this past 2 weeks, this has actually been one of the big topics that a couple of people have been discussing a lot. Budget Dog, if you guys have been asking him questions a bunch, has a strong stance on this topic. But I thought this was a good topic for me to talk about because I've been on both sides of this conversation. I was once at the paying off your mortgage stage, no matter what. But now I'm at the investing side. So I want to share a little bit about my journey as to why I switched, and then a little bit background on both of them and kind of why they came to be. Just quick introduction on myself. My name is Sean Cranston. I go by TheWealthDad. I'm a self-taught investor. I invest exclusively in index funds in the stock market. The only piece of real estate that we own is our primary residence. We own a townhome in Northern Virginia. I am a husband and a father. I do have one son and one daughter. Our daughter was born just about 2 weeks ago. We have investment accounts open for them as well. I'm also, I guess I can call myself a two-time author now. My first book, Index Fund Investing 101, teaches beginning investors essentially all that they need to know about index fund investing, which is one of the most simple forms of stock market investing. It teaches investors how to build and manage their own portfolios by giving sample portfolios, as well as the exact index funds and ETFs to use to build those portfolios. And then it teaches you how to manage those portfolios over time in both retirement accounts as well as a taxable brokerage account, and then how to withdraw from them later in life when you hit retirement. So it's a good starting guide for a beginning investor if you ever were interested in learning that specific type of investing. My next book that I am writing, about 2 chapters done from it, and then it'll be off to peer review, is called Investing for Your Children 101. This is for parents and would-be parents who want to start building wealth for their children. And it teaches you ways or accounts that you can open for them for, let's say, college. If you want to open an account for them that isn't necessarily for college, but you just want them to have money, there's accounts for in the book within there. There's also ways to jumpstart their retirement accounts before they hit 18, and then as well as other ways. So that book is going to be released about a month from now on July 16th, and I'm actually opening pre-orders up for that book starting tomorrow. For 20% off. So that's a little bit of background about me and what kind of I do in my spare time. I'm also I work a 9 to 5. I work in business intelligence as a BI developer / analyst. I always list this to show people that you don't need to be working in the field of finance or have necessarily a financial education background. I didn't go to school to study finance. I studied criminal justice, and I've been essentially teaching myself every step of the way since graduating from college, because nobody in my family, I don't come from a family of wealth, so I had to learn all of these things about the stock market, budgeting, real estate, all on my own. So it is proof that you can do this yourself too. Doesn't matter if you're a police officer, firefighter, teacher, nurse, whatever the case may be. This is knowledge that you can learn if you're willing to put in the work to learn it. You can also find me outside of the Discord on Instagram and Twitter at TheWealthDad. Pretty simple. Also, if you want to find me on Discord, I'm usually in the index funds, dividends, value investing, and personal finance chats. I frequent in those chats a bunch to answer any questions that are going on in there, or you can DM me in the Discord and ask me your questions directly, and I'd be more than happy to help out with you. Just be patient with me. I do get a bunch of DMs on both Instagram and Twitter, as well as the Discord, so it might take me some time to respond to you, but I will get to you in time. So now that you have a little bit of background about me, what am I exactly going to talk about? So the introduction kind of puts this as someone has to be a winner. It's either got to be paying off your mortgage early by extra principal payments or investing the difference. That's not what my conversation is going to be about. This is going to be very different for everybody based off of their kind of risk preference, how quickly they think they can pay off their mortgage, and the multiple variables that go into this. What I want to show you at least is the math behind it, so you yourself can make an educated opinion based off of what your situation is. It's not going to be cookie cutter for everybody. It's not cookie cutter for me. I have a different situation than than the admins. It's not all the same. So in this, I'm going to go over kind of where this early mortgage payoff strategy came from, and that is Dave Ramsey. A lot of us admins have read his book, kind of gotten our philosophies from his baby steps. So we'll go into his baby steps and kind of how they were formed. Also, we'll talk about the historical 30-year mortgage rates versus current rates, which is very important in this conversation. Sorry, let me just check. Can you guys hear me all right? Okay, seems like you can. We're also going to talk about the S&P 500 historical returns, because it's important to put both of those metrics together historically, the mortgage rates with investing rates. And we're going to use the S&P 500 for investing rates. So we're going to talk about a little bit how they've done historically, how they're doing now, and then compare the two, so we've got a good idea on where we stand on both. Then we're going to use my example as essentially a mortgage payoff strategy. My old strategy being I was making extra payments on my mortgage, and my new strategy is now I'm investing those extra mortgage payments into the stock market. So I'll show you the breakdown on both of those strategies, and then we'll finish with a comparison of both strategies based off of the math scenario that I ran for both strategies. And then after that, we'll do a question and answering, and I'll do as much as I can to answer your questions pertaining to this as possible. So Dave Ramsey's baby steps. Once again, this is where this is where I got my mentality towards paying off my mortgage early came from. And it's where a lot of personal finance kind of nerds got their idea of paying the mortgage early off. So Dave Ramsey, if you don't know, is a famous best time selling author. His main book is The Total Money Makeover. It teaches 7 baby steps to get into financial independence, or to get yourself out of debt and then to build wealth. It is, I will say, one of the best books on personal finance. It completely changed my mentality towards money. Definitely recommend this if you are just starting in your money journey, or if you're drowning in debt. This is a great book to kind of transform how you view money, how you view debt. It definitely did a number for me. But if you haven't read it yet, the summary on the right is here's his 7 baby steps to essentially financial freedom. Step 1, save $1,000 emergency fund. Step 2 is once you have that emergency fund, you're then going to pay off all of your, excluding your home, using what's called the debt snowball method. And that means you pay off your smallest amount debts as opposed to interest rate. So if you had like $1,000 credit card debt, a $10,000 car loan, $30,000 in student loans, you would pay off the smallest debt, being that credit card $1,000. Then you would essentially snowball those payments into your next highest or your next lowest debt, which would be the $10,000 car loan, and then so forth. Once you've paid off all of your consumer debt, then he wants you to beef up that emergency fund to 3 to 6 months cash emergency fund. After that, he then recommends investing 15% of your gross income into retirement. Then after that, start saving for your college fund. And then once you get to that step, here's the critical step where this kind of mortgage payoff strategy comes from. He wants you to then pay off your home completely, but you're still investing 15% of your gross income towards retirement, which is a good thing. But this is kind of where a lot of us, including myself, got the mentality, okay, this is the next logical step to take, is to pay off, use all of our disposable income to then pay off the home. And then once the home is paid off, it's then to essentially build wealth how you please, investing more in the stock market, not getting into debt, and then giving. And I want to make a note of this, that this book was released in 2003. So when we go over these mortgage rates and do some comparisons, you'll see kind of where these steps actually made sense when he wrote this on a mathematical standpoint. Although his teachings do come from a biblical sense, it definitely helped. And when I say biblical sense, he uses the phrase, the borrower is slave to the lender. He used that a bunch. But we're going to see how the math supporting that biblical sense also made it a lot easier for essentially this pay off your home early step to make sense, but why in today's world that might not make as much sense depending on who you are as an investor or homeowner. So mortgage rates, this is the very first thing that we need to look at. So on the very left, you'll see numbers on the average historical 30-year mortgage rate. This means what you would have essentially signed up for as a homeowner in each of these decades in the United States. So in the 1970s, 30-year mortgage rates were about 9%. If you look on the right, the current rate, I pulled this off the Wall Street Journal this morning. The average 30-year mortgage rate for a new home is about 3.1%. So in the 70s, it was triple the rate as it is today. In the 80s, it was almost quadruple the rate, or more than quadruple the rate, 12.7%. And after the 80s, it then starts to decline a little bit. So the 90s, it was 8.1%. The 2000s, it was 6.3%. This past decade, the 2010s, it was pretty much 4%. But once again, right now, we're currently at historically low mortgage rates, 3.1%. You'll see what my mortgage rate is in a second, but I've heard stories of refinancers and even people getting new mortgages who have even gotten it in the low 2% or mid 2% in this past year. Extremely cheap debt if you know how to manage it. But the key word is if you know how to manage it. So let's go now to the investing side of it. Now that we kind of have an understanding of where the mortgage rates have been historically and where they are today. So let's use the S&P 500 as an investing example. On the right, you are going to see the annual return for the S&P 500 that includes both the appreciation throughout the year or the growth of the S&P 500, as well as the dividends that are given off by the S&P 500 that are reinvested back into the S&P 500. So currently this year, the market has actually been crazy up. We're at a little over 13% this year with dividends reinvested, not far off what the actual 96-year average annual return. That's from 1926 till 2021. That's about a little over 12%. If you take into account the average annual inflation rate, and I was able to date this back to 1914, it's averaged a little over 3% a year. So if you subtract that average annual inflation rate right here, this red highlight, and you subtract it from the average annual return of the S&P 500, you get a 96-year average real return of 8.92%. What that means is after inflation is accounted for, the S&P 500 has historically averaged just about 9% a year in returns. But once again, the important part about this, or the main part you have to remember, this is with dividends reinvested as well. This for an investor, this means that they're not taking their dividends in form of cash and using it. They're taking all of their dividends every single year and automatically reinvesting it into their investments. So that's the investing side of the historical numbers. Let's do a comparison now and then kind of tie it back to Dave Ramsey, and you'll see where the math was kind of making sense as to why it helped write this book, and also why why it was never questioned as much. So in the 1970s, once again, 9.02%. Now we go to the 80s, where it was the highest since I did the ranges from the 70s, 12.7%. The note here is this is actually when Dave Ramsey himself went broke in this decade, in the late 80s. He was a real estate investor, and then I think a lender acquired his bank's lender, and they called all of his mortgage debt, and he had to file bankruptcy. So he went through bankruptcy, adopted a new money philosophy of debt is bad. All debt is bad. Once again, he bases it off religious or biblical reasons. But the math also supported this. So it definitely helped in essentially creating his philosophy and then eventually selling books and products. In the 90s, when it was 8.1%, that's when kind of Dave Ramsey launched his first Financial Peace University, Financial Peace, the book. And that's where the audiences first started hearing about who Dave Ramsey was as a personal finance figure. In the 2000s, when mortgage rates were 6.3%, that's when the famous book, The Total Money Makeover with the 7 baby steps, was released. I believe I said it was 2003. And then if you keen in really on the 1990s and 2000s, when mortgage rates were, let's say the average of 6.3 and 8.1% is 7%. If you can theoretically, or let me change this. How am I going to say this? by paying off a guaranteed 7% mortgage rate, it made a lot of sense when you compare that to investing per se in a stock market that is volatile in the short term, but it does have a long-term track record that's a little higher than that 7%. But it made sense as a as a mortgage holder, if you owned your home, to pay off your mortgage because the difference wasn't that massive in terms of money that you could be leaving on the table. And that mortgage payoff was a guarantee. Like I said, when you pay off your mortgage rate, that's a guaranteed return of that percent. So it made sense if you have like a 7% mortgage to pay that off. That's a great kind of way to get a good return on your money. But as we get kind of closer to the new age, 4.1%, 3.1%, if you go back to the investing side and we look at this as a comparison, you're almost giving, if you are a buyer as I am, so I bought in the year 2000, last April. You'll see my mortgage rate in a sec. I bought at a 3.25% mortgage rate. Looking at the S&P 500's historical returns, I'm almost giving up triple, or what is it, 3.1% to about 9% real return. I'm leaving almost triple the value on the table by paying off my mortgage as opposed to investing. So investing, I will say that future returns are not guaranteed based off of past performance, but that difference was too much for me to continue to pay off my mortgage. I had to run the numbers for myself and see what I'm potentially leaving on the table by trying to pay off my mortgage early versus investing. That difference was just too much for me. So now I kind of finally started to evaluate where I was in this journey. So now let's talk about my old mortgage payoff strategy. So on the left, this is our townhome. This is our starter home that we bought in April 2000 in Northern Virginia. It cost $330,000 when we bought it. We fortunately bought it at the right time because, as many of you know, the real estate market has gotten as hot as ever. Actually, it's probably been the hottest it's ever been. I think the annual increase on homes has been just north of 20% in the past year. So our home is currently valued at like $390,000 now. So we've had a great return just on the value of our home and owning throughout this year. But the terms on our mortgage was we used a 30-year mortgage. The rate was 3.25%. And after a year of paying down that mortgage, I think our starting balance was $264,000. Our current loan amount is $253,000 and some change. And what we've been doing every month is we've been paying our mortgage and then throwing an extra $400 a month at the mortgage principal. 400 was a number that we came up with when we ran our kind of budget, and based off of where we were allocating money, that's the amount we were comfortable allocating extra to the mortgage, as opposed to adding more. We didn't want to dampen our retirement funds, our early freedom fund, as well as our children's investment funds. So for the sake of this argument, $400 is the most that we are going to work with moving forward with extra mortgage principal payments. Under that plan, it had us paying off our home in 18 years, in the year 2039. So it essentially was going to pay our 30-year mortgage off 10 years sooner, meaning it was essentially a 20-year mortgage. And with that strategy, it was going to save us a good sum of money in interest, a little over $51,000. That's definitely a nice number. I love the idea of not paying an extra $51,000 in interest to a bank. But once again, I started really thinking these past couple months, previous to the conversations I've been seeing on Twitter, which have been great conversations, but I was leaving too much money on the table now as someone who's dedicated with their finances. So if we keep going, actually, let me show you a calculator real quick, just so you can work out how to get these numbers on your own based off of your own mortgage. So Bankrate has a fantastic early mortgage payoff calculator. So if you just go to Google and Google Bankrate early payoff calculator, it's going to be the first one that comes up. And I'll show you how to operate it real quick so you'll know how to run the numbers for your own situation. So years remaining is the first part. Don't put in what your original mortgage was. Put in how much is left on it. So for me, we've been paying our mortgage for about a year now. We've got 29 years left on our mortgage. The original mortgage term is what you're going to put for your original, what you signed up for. So for us, it was a 30-year mortgage. Our original mortgage amount actually was $264. So I'll update there. Our additional principal payments, $400 a month. And then interest rate. This is where you're going to put in whatever you signed up for. So if you, whatever reason, bought, I don't know, 5 years ago when rates were like in the mid 4%, you'd put 4.5%, and it would update your numbers to there. But for my sake and purposes, 3.25% annual interest rate, and hit enter or hit calculate. So where you're going to see essentially right here is these numbers. So scheduled payments means what it would have been if you essentially paid the mortgage off without paying any additional principal payments. So you're just paying your mortgage off at its normal rate for 30 straight years. It would cost me about $413,000 in total payments. With the accelerated payments, it trims off a little over $50,000. So where I told you I would be saving $51,000 in interest, that's where you're going to see that difference come from right here. So if you were to go to this calculator, input your numbers, you're going to subtract these two numbers to see what your interest saved is by paying off your mortgage early. I fortunately have a investment or like an early payoff calculator on my mortgage website. So that's where I got my information for the $51,000 in interest saved. Your mortgage company will most likely offer you a similar calculator that you can input the numbers as well, and it'll tell you your interest saved by paying it off early as well. So let's go back to the slide deck now. So my new mortgage payoff strategy, I wanted to run the numbers on if I invested that $400 a month as opposed to putting it towards my principal payments, what could that potentially look like in the future? So I put an image of the S&P 500 on the left as an example, because we already know what the average annual returns of the S&P 500 have been historically. With dividends reinvested after inflation, it's averaged about 9% a year in total returns. So my new scenario now is investing $400 a month, and instead of putting it to the mortgage, I'm putting it in a taxable brokerage account. This is just a regular investment account that I can funnel money in to essentially allocate to pay off my mortgage eventually. I'm just putting it in a different area as opposed to my mortgage. The investments I personally use are a combination of VTSAX, VTIAX, and VGT. These are all low-cost index funds and ETFs that track the total US stock market, the total international stock market, and then VGT is an information technology ETF. So in my scenario, I use a hypothetical annual return of 8% growth on my investments every year. And at the end of an 18-year investment scenario, I use 18 because my mortgage payoff simulation would have had me paying off my mortgage in 18 years. So I use the same exact timeline for my investment scenario. And at the end of 18 years, that would have grown to a little over $192,000. So I'm going to show you an investment calculator before I get into the breakdown and comparison of both of those, so you can kind of see the numbers on each and why we went with where we did. So Dave Ramsey I use his investment calculator a lot. So you can go to Google and just type Dave Ramsey investment calculator, and then his link should come up as the first one. How you use an investment calculator is very simple. So you're just going to input your current age. This says enter the age you plan to retire, but in this instance, I just need this to look 18 years ahead of time. So I believe that's 47 years old. I'm going to assume I put no money in this mortgage payoff taxable brokerage account, but I will be contributing $400 a month to this account. And then my annual return that I expect is 8%. You'll hit calculate, and that's where I got that $192,000. So that's how you use a basic investment calculator. Dave Ramsey's is a pretty easy one to use. There are some complicated ones, but that's how you would essentially work an investment calculator. So now you've seen how to calculate an investment calculator. You've seen how to potentially use a mortgage payoff calculator to get the difference in a regular payoff strategy versus an early payoff strategy. So now you at least know how to get your basic numbers for yourself in your own mortgage. So strategy comparison now. I went with the new strategy of investing, and this is the big picture. So I'm going to try to speak through this math slowly, but this video will be posted as well if you want to go back to it in case you don't follow exactly everything that I'm going with this math. So step one, I'm no longer paying $400 a month towards my mortgage. I'm now investing that $400 a month instead into my taxable brokerage, spread out through those 3 index funds and ETFs that track the total US stock market, total international stock market in the information technology sector. And now the assumption is now that I'm also not sending those extra mortgage payments, my mortgage balance after 18 years, where it would have been paid off in the previous scenario if I was sending the extra payments to, that balance is going to be $117,000, a little over $117,000. So I'm not paying extra on the mortgage. So that's still, it's not getting paid off anytime sooner. So there is still a mortgage balance by the time that 18-year scenario comes about. But my investment returns after 18 years are $192,000. The contributions were a little over $86,000 and the earnings were a little over $105,000, making up that $192,000 return. So now in step 4, this would be what's called, I'm calling it the hypothetical brokerage liquidation. This is if I wanted to pay that mortgage off at that 18-year mark, which would have been the same time that my mortgage would have been paid off with the $400 extra a month. And here's how I would go about the math in determining how much money I would have left after doing that. So when you liquidate a taxable brokerage account, you also have to keep in mind that you're going to pay taxes on the earnings of your growth. So I can't project what long-term or what capital gains rates are going to be in the future. So I have to use what we have now. So the current long-term capital gains rate is 15% in the United States. I don't know if there's any international callers in here right now, but it's 15%. So if I liquidated that entire $192,000 brokerage, I would owe just about $16,000 on that $105,000 in earnings. And that would give me a post-tax investment account liquidation value of $176,000. So after paying capital gains taxes on that liquidation, I've got a little over $176,000. So now I can cut the check to pay off that $117,000. So the math of that would be, I would take my post-tax liquidation, subtract it by the mortgage balance, 117, and it gets me a remaining payoff cash balance of a little over $58,000. I actually probably didn't go as deep in this last payoff. If I were to lump sum paid off this mortgage, there would most likely be, or there's not going to be most likely, there will be extra interest that's tacked onto this. So let's say an extra $10,000 or $12,000 was taken off of this. So it actually might be $40,000 in remaining cash balance after I paid my mortgage off. So that was a lot of math, but I'm going to do one last little breakdown for you to show that kind of simplifies both of these strategies even more and why it made sense for us. So the results comparison. The first scenario, my original plan, had us paying $400 a month into the mortgage. It would pay off in 18 years, essentially trimming 10 years off the mortgage. It would save us $51,000 in interest payments. And at the end of those 18 years, the assets that we would own with that strategy would be a completely paid off primary house. That's fantastic. I think everyone has a goal to have a fully paid off primary home. And that's what drove us for such a long time. That is what we wanted, the paid off house. But with the new plan, investing $400 a month, and at the end of 18 years with that final portfolio value of $192,000, and then eventual liquidation and then paying off the mortgage balance, the assets that we would own at that point would be a paid off primary home, as well as that $58,000. If you want to say 46 for the interest that they'll tack on that we haven't yet paid, then it's $46,000 in additional cash and investments that we are left with. So in the second scenario, we got the same asset owned, essentially getting the paid off house, but we have a surplus now of an additional $46,000 in cash, or it's still being invested within our taxable brokerage. Before I get to that. And this is where I once again want to highlight where I'm not on either side of these strategies. And I've been on, essentially, I've done both of them and I've understood both points. So I don't think there's a necessary clear-cut winner. but I definitely want you all to understand at least the math behind making these decisions for yourself. Because for me, as a young homeowner who just bought at a stupid cheap rate, my scenario is 10 times different than, let's say, someone who's 38, has 17 years left on a 30-year mortgage at maybe they don't have the best credit and their mortgage rate's like 6%. Their numbers might make more sense to pay off the payments with extra principal payments than it is to invest. It might make more sense to them to put those additional payments and get that guaranteed 6%. But hopefully by seeing how to use these calculators, seeing how I ran the math for myself, you can now input your own values into these calculators and start to at least understand the math behind those decisions so you can make the best informed decision possible for you and your family situation. And I stole this tweet from a guy I follow on Twitter. He's another personal finance guy on here, but he summed this up in a great way, and it's how I view this as well. I don't know if Budget Dog's listening, but he kind of fits into this a little bit as well. So Mark is another guy who is he stands for investing over paying off your mortgage balance. But what he is saying is, regardless of what you do, if you have the idea that you're going to be fully aggressive in paying off your mortgage, it's going to be best if you can get that done in the low single digit years. So if you can get absolutely crazy and get your mortgage paid off in 1 year, 2 years, 3 years, I don't even know if I would even stretch it to 5 years, but if you can get it in those low single digit years, go for it. That more the power to you. That would be a fantastic goal to do. But if you're in a situation where you don't have the highest income and you've got a 30-year mortgage, or you got 28 years left on it, and you got a really low rate, let's say you got 3.5%, those extra mortgage payments might not be the best financial decision for you, because if you're only putting in a couple $100s a month and it's still taking you, 15, 16, 17, 18, 19 years to pay off your mortgage, yeah, you'll have a paid off home in 15 and 20 years. But if you're not really in a high income career and most of your money is tied up in a home, although you'll have the quote unquote peace of mind with the paid off home, your assets might not be in a position where you're close to retirement. Your expenses will be lower, but you still won't have the assets that are paying you in the form of stocks, rental properties. So I thought his tweet was a great way to kind of sum this up regarding mortgage rates. So hopefully you guys have kind of got a better understanding now on how to do this math, a little bit of insight on how I did it, what we're doing now. And my mind constantly updates with how, kind of times change. I couldn't just take Dave Ramsey's advice at face value anymore. I had to run the numbers for myself to see what would be best for me. And then the last thing I'll say before I get into questions and answers is, if you're in the same scenario as me, let's say you're doing the same thing I am now, you're going to switch from doing extra mortgage principal payments to investing. You have to be dedicated in making sure you're investing that same amount every single month. So where I'm investing $400 a month now, I'm dedicated enough and committed enough. I know I'm going to invest that $400 a month. You can't half-ass it. So you can't do like $400 this month, maybe take the next month off on vacation, and start back up in 2 or 3 months doing $400 a month. You have to be dedicated to this kind of investing plan. You have to reallocate that money and pay it or invest it every month, just like you were in the mortgage. You can't go, none of these strategies are going to be great if you're going to be going in and out of each of them. So just stick with them, just be committed, run the numbers for yourself. And hopefully you guys are able to gain some value out of this presentation tonight. And with that, I'll open it up to questions and answers. Feel free to ask it verbally or put it in the chat. I'd be more than willing to answer your guys' questions.
Hey, Sean, I have a question. Can you hear me?
Sorry, I actually had you guys on mute. If you guys have been asking questions, I have not been able to hear you. So please ask your questions now.
That's my bad. Can you hear me?
Yep, I can hear you.
Hey, Sean. So in regards to the individual brokerage account,
Mhm.
I completely like I'm with you on the diversification. I'm invested in VT Sacks myself, but I guess I'm just curious because I mean diversification definitely at its finest, but like that $400, do you split that between the three different funds that you chose, VT Sacks, the VTIAX, and VGT? Like, do you spread that $400 in different like in those three funds?
No, not necessarily. So I do a kind of automatic rebalancing on a monthly basis. So based off of how, or let's assume we're 2 weeks from now, July 1st, right? So based off of how the stock market does in June, I'll see where my asset allocations are with those three funds and base that off of what my desire. So if I've got like a 30% or like a 33%, 33%, 33% evenly split allocation, if one of my investments, let's say VTIAX did terribly, VTSAX and VGT did great, and my balance is out of whack, I'm going to probably allocate that entire 400 to my loser of that month and kind of rebalance my portfolio by buying for my losers. So it's not the same each month. I don't like dedicate it specifically to VGT, VTIX, or like an even split. I base it off of where my allocation is at the start of the month. Does that make sense?
Yeah, no, that makes a lot of sense. I feel like people that talk about that don't really go into depth on that. So I appreciate that. Yeah, no, that makes sense.
And
So
then by
you
doing
just put more into the losers.
yeah, so in a taxable brokerage to avoid capital gains taxes, it's smarter when you rebalance, just buy more of your losers as opposed to like selling your investments, which you can do in a retirement account because you don't have to worry about capital gains. So just buy more of your losers in a brokerage to avoid that capital gains tax.
All right, sweet.
Yeah. Let me, here, I'll put my funds in here that I'm invested in. Oh, someone already got it. There you go. And once again, you can ask your questions in the chat as well. Hopefully you guys can hear me. Hopefully it didn't get out too much. See, someone had a problem with that. Yeah, 12% rate back in the 70s. That's crazy to me. I can't, it's almost hard to imagine borrowing at that high of a rate for a mortgage back then. We're definitely in a much more fortunate borrowing position for real estate than our parents and grandparents were. At that time, it's almost a no-brainer. I would almost pay off my mortgage back then as opposed to investing any money. And I think that's why a lot of our parents have that kind of no debt mentality, because it not only made sense for them, but like mathematically, it made total sense for them. A 12% guaranteed return by paying off that mortgage early. $2.37%, that's money. I don't know if Brennan, if that's budget dog, probably is. Yeah, I've heard Toronto and Vancouver are nuts. Don't be house poor. Especially don't be house poor if, and I'm not saying this to be mean, but if you're in a low income career and you're kind of living paycheck to paycheck, being house poor is not the way you want to build wealth. What that means is if you essentially focus, let's say you're like a single teacher and you make $50,000 a year, and your key means to building wealth is essentially paying off your house. Let's say you even paid off early in like 25 years as opposed to 30. If you get to like 50, 55, and the most of your wealth is in a house, the only way you can really tap that wealth is if you sell the home and keep the cash, but you got to have a place to live anymore. But being house poor is definitely not where you want to be have the majority of your wealth in. You definitely want to have assets outside of your primary residence. And this is a great point that Decade Investor made. So the only downside of the investing is you're assuming the market will continue at an 8% rate. That's obviously not a guarantee. And that's why I wanted to highlight back in the 90s or the 80s and the 90s when rates were 9%, 7%. 6%, the math made total sense to take that guaranteed return, because I would even probably take a 6% guaranteed return over a hypothetical 8% return. But for me, now that rates are 3% and in some situations sub 3% in the 2%, that difference for me is just too large of a gap now, to where I could ignore. And if I can't, as an investor, achieve close to 8% returns over 20 years per se, then I'm either a terrible investor or we're in for some very choppy times ahead of us, and a lot of us could be struggling. But like I said, that difference was too much for me to ignore. All right, Brennan, what do you got? 46K was the ultimate opportunity cost in 18 years more with the mortgage. And see, so this is a hard question to answer too, because anytime you so theoretically, yes, my opportunity cost was $46,000 and it took 18 years. But remember, based off of my budget, we're only allocating $400 a month. We're not putting anything more. All of our other money goes elsewhere. Could I we're putting like $5,000 to $6,000 a month into our brokerage right now. Could I reallocate that money towards the mortgage and pay it off early and then rerun numbers based off scenarios? Sure, I could. But that money has already been allocated to goals outside of just paying off our mortgage that are separate. So doing these kind of back and forths is tough, because you would almost have to rerun every scenario and then make different assumptions. So there's never going to be a right answer to these. You just kind of have to base it off of your situation and what you think is going to be best for you. How did you come up with the 8%? Let me go. I'm going to go back to the S&P 500 slide. Hopefully you can see this. So what I used was I dated back all the way to 1926. I used the annual returns for the S&P 500 that included both dividends reinvested as well as the growth of the underlying stocks. And then when you take into account inflation, which was 3.23%, you got an average real return over 96 years of about 9%. I did 8% just to take off of that, just to be a little bit more conservative. That's where I got 8%.
These things you're leaving? Huh? These things you're leaving? Is that one of y'all underwear? Runner.
Hey guys, don't forget to mute your mics. We can hear you. All right. Sorry, let me scroll back up. 8%. Index funds. I'm 16 years into a 30-year mortgage. So you've got 14 years left at 3.5%. I'll be interested to see where your numbers will be at, because you're getting closer to your payoff date. And the difference might not be as big as you think. So it definitely makes more sense. The closer you are, or the further you are away from your mortgage payoff, the more essentially value you're going to potentially get in an investing scenario. So when you run your numbers, I think you'll be closer than what you might think, but it's definitely valuable to still run it. Let me know how that goes for you. If you want to shoot me a DM, see what your numbers are, we can actually go back and forth in the Discord. This is a good question. I'm unmarried, don't have kids. So I've been investing and focusing on accelerating wealth building. What are things to keep in mind when it comes to buying a home? So I was of the mindset all the time to put 20% down on a home. I put 20% down on my house. That's just kind of what I knew. And that was based off of everyone saying you're going to avoid PMI. That's I think, what's it called? Is it private mortgage insurance something? But essentially it's insurance that you have to take out that protects the lender if you default because you don't put enough money down. But with home values shooting up in value like crazy in this past year and homes getting outbid by $30,000, $40,000, $50,000, putting 20% down on some of these homes is going to be very difficult for people. So if you follow the I think this is actually Dave Ramsey's philosophy. If you save up for 20% down, for a lot of people, that could be saving for 5, 6, 7, 8 years before you even buy a house. And by then the houses could have appreciated even more. So what I would say is the most important is don't necessarily worry about 20%. What you want to worry about is buying a home where your living cost is between 25 to 28% of your gross monthly income. That means if you make, what is it, $5,000 a month, you want to, what's 20? Let me do some math real quick. Sorry for the slow computer. I'll just do it off my head. 10% of 5,000 or 5,000 is 500 times 2 is 1,000 times half of that. So if you make like $5,000 a month, you want your mortgage payment to be about $1,250 or $1,250 to like $1,350. So you want to make sure that that not as much of your monthly income is going towards your mortgage, because that's where we're talking about being house poor. So I wouldn't necessarily worry about 20%. I would say as soon as you can purchase a home with whatever you have down, whether that's 5% or 3%, 5%, 8%, 10%, as long as you can get it where that monthly payment is 25 to 28% of your monthly income, that then frees you up to then invest in retirement accounts, taxable brokerage accounts, or if you're of the, I want to pay my mortgage off early, gives you extra funds to pay off your mortgage if you want to do that. So I would focus on the monthly payment or the monthly payment in terms of the percent of your gross income, as opposed to putting 20% down. Hopefully that helps you out.
Yes, thank you very much. That was my question. I just have an additional question. I want to know how much to put just aside for just like maintenance, like as far as like repairs, anything that comes up.
In terms of like when you actually own the home?
Yes, yes.
So I actually think, so if you're a homeowner, how many sources of income do you have?
3.
3? Okay. So this is different for everybody. If you're a homeowner, it's definitely best to have kind of in that at least 2 to 3 months expenses. So if expenses for you are $2,500, get $5,000 to $7,500 saved in cash just to have on you. I would also make a note when you buy the house, what are the major things coming up? So if you've got an old roof, those are expensive. That's in the $15,000, $18,000 fixes. But if you're just like, if the oldest things are like water heaters, where those are like, I don't know, $1,000, $1,500, not the biggest deal. Really depends on the house you buy, how old it is, how new it is. If you buy a much older house that has a lot of outdated features, you might want to beef that emergency fund up to 4, 5, 6 months. So it definitely just kind of comes down to the home that you eventually purchase. If you buy a brand new home or condo, you might not need that cash because everything is brand new and you're not going to worry about it for a little bit. And then you can be okay with that kind of 2 to 3 month range. Does that make sense?
Yes, perfect. Now I see why a lot of people are at Home Depot so often.
Yeah, you got a lot of do-it-yourself people now. It's also hard to get labor now because, I mean, everybody's booked for deals. Lumber's crazy expensive. So a lot of people are kind of taking it to themselves now. But don't take things like roofing and stuff to yourself. Still hire out for that. That'll just be bigger disaster for you.
Thank you.
Mm-hmm. Yeah, it'll be interesting when this mortgage forbearance and foreclosure stuff opens back up and foreclosures get back on the market, because the supply is crazy low right now. We tried to buy a second property in our own townhouse neighborhood. It was a flip. So someone took essentially the same exact model of our home and redid everything. So what we were going to do is buy that house, live in that one, and then rent our current house out. And we actually came in second place while still offering about $55,000 above asking. That still wasn't enough. So that's just not exclusive to where I live in the hot market of Northern Virginia, which is right outside of Washington, D.C. That's nationally, even in Canada. I'm hearing crazy stories in Canada. The low supply and low interest rates are driving these bidding wars like no one's business. It's crazy. Awesome. Glad you enjoyed. Refinance last year, 15-year, 275. Trying to buy another property. Another thing I want to bring up too, I don't know how many people are on here. How can I check? Doesn't this thing come up? 78 people. All right, so good enough. We can talk a little bit more about this. So you're often going to hear the phrase peace of mind come out from people. I got a peace of mind paying off my home early. And I don't get into those conversations for peace of mind because that's an independent variable, meaning peace of mind is absolutely different to every single person. What's a peace of mind to all of you on this chat might be completely different for me. For me, peace of mind, I've got a relatively stable family, not to get too personal, but on my wife's side, she comes from more of a hard background per se. So there's individuals in her family that might need financial assistance later in life. I'm almost guaranteed of that. So financial or peace of mind for me is when I get to those later years in life where my kids are out of high school and I've got aging parents or aging siblings on both sides. I know there's going to be a potential worry that family members are going to be struggling. So for me, peace of mind is having more liquidity, having more money to potentially help these people out, as opposed to the paid off mortgage. While having a paid off home is a goal of mine, it is not the superseding goal of mine. So that doesn't dictate what my peace of mind is. My peace of mind is more geared towards liquidity as I get older. And as I've had kids, those independent variables increase. I can't control. I believe I'm going to raise my kids right, but they are their own people. So I can't guarantee what they're going to be in 18 years. So for me, I've got a lot of independent variables in my life as a father, as a husband, to someone who has their own family. So I need to be prepared for my peace of mind to have as much cash liquidity later in life to be able to deal with those potential hiccups if and when they come. .25% of 15-year. It's crazy. I've seen someone, I don't know if it had to have been a 15-year. A girl followed me on Twitter, said she got a rate or a refinance rate of like 1.93, which that's absurd. That's almost like stealing money when you kind of invest that over the long term. So you're definitely, if you're sitting on a high rate that you kind of bought a couple of years ago, like 5%, 6%, 7%, the refinance rates are still hot. I would definitely get in there if you can and then get these low rates. Even if you don't plan to pay off your mortgage early or invest, you're going to save hundreds a month or hundreds a month potentially on interest payments, and then tens of thousands over the course of the entire payment just on that refinance. That's the Ramsey investment calculator. Let me put the bank rate one in here as well. There's the bank rate, or did it get out? That's the early mortgage payoff calculator by bank rate. Okay, thanks. So 3.75% is pretty low. I'm not sure what like I said, I don't know what your credit score is. I don't know what the rate could be. If you can get that to below 3, so if you can get essentially trim 7.5 off that, a full percentage point, it's probably going to be a good idea for you. See how much they would potentially charge you to do it, if they would charge you at all. Message me directly though, so I can give you kind of a better understanding. Generally, if you want to save money in total interest over the course of a loan, it definitely could help to trim that interest rate, but shoot me a direct message and we can talk a little bit more about that. Do you think the housing bubble will pop? So I'm more of a stock guy than I am a real estate guy. Like I said, the only real estate I own is my own primary home. So I can't speak as much on how real estate markets have done historically. And also real estate markets are much different than the S&P 500 is a national index. So companies all over combined into one. Real estate's different. Real estate markets are different based off of where you are in the country. So I live in Northern Virginia. Even in like 2008, home values didn't really like get affected too much. This is that jobs are always plentiful in this area. There's tons of military bases. So the area I live in doesn't really get affected by quote unquote housing bubbles or downturns. They might just kind of stay stagnant for a little bit or just appreciate at a slower rate. But if you're like in a small like farm town, I don't know. If you're in the Midwest, it could be much different. If you're in the Northeast or Northwest or Southwest, it could be very much different. Me personally, though, in terms of the housing bubble, I don't think it will, at least not in the next 2 years, because this is different from 2008. 2008, you had a bunch of people who couldn't afford homes buying a lot of homes. So it eventually collapsed on them when everything came apart because they couldn't afford the homes that they purchased. This is different. We've got a low supply, but the buyers are financially secure. They're in good financial positions. These aren't essentially I don't want to use the term broke, but actually I'm going to use it. This isn't broke people buying houses. This is people with money buying houses. This is also financial institutions buying houses. So BlackRock is even buying a lot of these residential real estates. So I just don't see what would cause the bubble to pop personally, because the borrowers can afford the mortgages and it's cheap debt. If they were to lose jobs for say 3 months, they're in a good financial position to keep paying the mortgage. So unlike 2008, where once people like lost their jobs and they had 3 or 4 homes and they couldn't afford one of them, it collapsed. They had foreclosures all over the place. Now, like I said, I got outbid by probably a family that's in a much better financial position than me, or at least close enough to where it didn't hurt them. So honestly, I don't see a housing bubble. This is where I would concentrate on. If you can get that payment in between 25 to 28% of your monthly income, I would buy it. Even if you have to purchase at above market and overbid, I would still do it, because I just see houses continuing to go up at least for the next year and a half, 2 years. I don't see the slowdown coming, because there's nothing in the way to essentially say that it can stop. With low supply, new homes aren't getting developed as fast. There's just no way it's not going to go anywhere but up, at least in my opinion. Yeah, I heard Canada's absolutely nuts. I've heard people legit have just left Canada and like moved to the US or like been vacationing for months. How can you start investing in the S&P 500? So I use an example as a taxable brokerage account. So this is a regular investment account that you can open, that you'll pay annual taxes on the realized earnings. Realized earnings mean dividends or interest that your investments get, or if you sell your investments for a profit, that's capital gains. But let's say you open a taxable brokerage account with Vanguard or Fidelity or Schwab. These are major low-cost brokerages. Each of them offer their own S&P 500 index fund. So for example, I'll use Vanguard. Google S&P 500 index fund. Actually, Vanguard's got a high minimum fee for theirs, so let's use Schwab's. Schwab S&P 500 index fund. So you'll see right here, Schwab offers an S&P 500 index fund, which we used for the example. The ticker symbol is SWPPX. So once you create a taxable brokerage with Schwab, you would essentially link your bank account, like your regular checking account, to your now investment account. And you can either set up automatic contributions or do this manually. But at a high level, you're essentially just going to be transferring money from your bank to your brokerage account, and then using that transferred money to invest in this index fund. So let's say you transfer $200 from your checking account to your brokerage account. You now have got $200 in your Schwab account, and then you'd use that $200 to buy $200 worth of this S&P 500 index fund. That'll buy you like 3 shares and some change. But that is at a high level how you can buy an index fund. My book, I don't know if you were here at the beginning, Index Fund Investing 101, will also teach you how to do this if you want to as well, by giving you sample portfolios and funds. So hopefully that helped you out a little bit there. First mortgage, 1.98%. Wow, crazy. 1.75 for that's, yeah, great. Debt is stupid cheap. If you are financially savvy, it is a great time to be a homeowner, to invest that difference. If you can dedicate yourself to actually investing it, it is a great time to build wealth over the long term. I'm not sure what exactly you're asking. This might be an actual good question, but I've been dealing with kids all day, so I'm kind of losing my sight and brain a little bit. Jeff, if you want to DM me, we can talk a little bit more about that, but I just can't think what you're asking right now. No problem. Hopefully you enjoyed it. I'm in Nova 2. I wonder what you mean by starting to see a change in the market. I see absolutely no change. I guess it's depending where you live. I'm right outside of Springfield, and I see the home next. So I bought my home for $330,000 last April. The home right next door to me is a slightly smaller home. They got a couple upgrades before they left, but they just sold theirs last month for $401,000. That's 70 grand more than what I bought my larger home right next door to them was a year ago. The home that we lost out on right up the street was $425,000. So the only changes that I'm seeing is that it continues to go up, and me and my wife were blessed to buy it at 330K last year. It seems like that was almost the last great time to buy is when COVID started, because you had buyers kind of getting scared. We actually were second place on our home, but the first buyer caved because they were nervous, apparently, that home values would drop or whatever the case may be. And we actually got accepted because they dropped. But since then, it's been chaos upwards. I can't really speak on California, but California is always expensive. Even I know a couple people who live in California, or I'll say lived, because they've all eventually moved back. I think I know one person who still lives there that I went to high school with, but everyone who came back with it's like, I loved it, but I just can't afford the living payments there, whether it's rent or trying to buy a home. It's very difficult. I don't believe TD Ameritrade has their own S&P 500 index fund. They're just a brokerage that services index funds. But on TD, you should be able to invest in either Vanguard, Fidelity, or Schwab's S&P 500 index fund or ETFs. I'm not sure if TD Ameritrade doesn't allow you to invest in index funds, but they should be able to allow you to invest in S&P 500 ETFs. Where can you purchase the book? I think you're talking about Index Fund Investing 101. So two ways. You can either DM me on the Discord, search for TheWealthDad, and I'll send you the link, or you can go to my Twitter or Instagram. And the link to the book is in top of my profile, so you can click there. Actually, let me just go to it. I'll put it in the chat. Make it easy. There you go. There's where you can check out Index Fund Investing 101. And you'll also be able to see the pre-orders for Investing for Your Children 101 tomorrow when I drop the pre-orders. No, Springfield, Virginia, sorry. We're right outside of Washington, D.C., about 30 minutes. This one is kind of past my area of comfort right now. Essentially refinancing, taking cash out, and then investing the difference. My opinion on this might change in like the next 6 months as I explore this a little more and if my risk tolerance increases, but we're in a good spot now where the only debt that we have is our home, and it's cheap compared to what we make on a monthly basis. So this was a big step in the direction of essentially opening up my risk recently and investing my early mortgage payoff strategy as opposed to paying it off early. So Jeffrey, unfortunately, I don't have a good answer for what I would do for you. I don't know enough about your situation, and I personally don't know enough about the process to give you a good educated answer on that. I'm noticing that's the change of man. I sold my home, had a bidding war. Oh, so, okay. So you are a beneficiary of the low supply. Good for you. I'm noticing more inventory in the area. Yeah, it'll be interesting. I'm not sure. I don't see many homes in my neighborhood getting for sale signs, but not sure where you live, but good for you for cashing out on that. Hopefully you made a good chunk of money and profit from it. I am too, Nicole. I'm not too far south of Springfield. Yeah, I'll put the book one more time. Thank you guys. I'm gonna, or real estate chat. Now, so you can actually find my book in the, what is it? The provider resources chat. I can't directly promote my book in any of the individual chats. If you're interested in it, you can DM me directly. Like I said in the Discord, just search my name, The Wealth Dad, and I will send you the link directly if you are interested. But thank you guys. I hope you guys enjoyed this. I hope, like I said, all I care about is at least giving you the ways to run the math for yourself. I don't want you to pick a side. I'm not trying to pick a side here. I just want, hopefully, that you know how to run the math for yourself so that you can make the best decision for yourself, not what others are telling you to do. So have a good night, everybody. I appreciate it again. And this video will be posted in the Wealth Squad University, hopefully by this weekend. So thank you, guys.